A global health crisis is transforming economies, industries, and communities around the world. It's creating risk and uncertainty, but also opportunity for investors. Here with me today to discuss some key benefits of investing in Asia high-yield bonds is portfolio manager Stephen Chan, who manages the PIMCO Asia high-yield strategy. Stephen, let's start with why this is a good time for investors to consider Asia high-yield as an asset class.
After the sharp economic contraction globally from a series of COVID-19 containment measures, we are starting to see early signs of improvement in activities, and many businesses in Asia are reopening. For investors looking to benefit from Asia's regional recovery, the Asia high-yield sector now offers a compelling level of yield after the recent repricing. Relative to US high-yield, Asia high-yield offers around 200 basis points of spread premium with higher average credit quality. This is quite wide compared with historical levels. The current spread level suggests that the market is also pricing in a double-digit default rate, while the 10-year average historical default rate is actually at just around 2%. On the valuation front, this is an attractive opportunity for long-term investors. Across the globe, particularly in Japan and Europe, there is a growing pool of low or negative yielding securities. With a lot of investors continuing to look for high income generating assets, we believe this is a supportive technical tailwind for Asia high yield bonds.
Thank you, Stephen. What value can PIMCO offer clients in the Asia high-yield space? Tell us a bit more about the team and the investment approach.
PIMCO has one of the largest Asia credit research platforms in the industry. We have 9 credit research analysts covering issuers across all the different sectors in the region. Our Asia high-yield process also benefits from 2 critical PIMCO resources: our global credit research platform and our emerging markets expertise. These allow us to leverage PIMCO's global industry insights to refine our sector analysis, compare opportunities versus non-Asia high-yield credit, while taking appropriate levels of sovereign risks. The fund benefit from PIMCO's unique top-down investment process and macroeconomic insights, while also having the flexibility to add tactical positions and hedges via our leading execution capability across instruments. We also thoroughly analyze each credit with detailed financial projection and ESG assessment to arrive at an internal rating and recommendation. We aim to identify resilient issuers with medium-term return potential in the market. Our selection also extends to individual bond relative value using our prominent analytics capability. As one of the largest fixed income managers, PIMCO's size enables us to engage directly with issuers, enhance our ability to structure advantageous terms, and secure favorable allocations.
The last question, which is important from a portfolio perspective: how can the PIMCO GIS Asia High Yield Bond Fund benefit or complement a broader portfolio?
I could think of 3 roles for the fund: as a diversifier, a yield enhancer, and a provider of decent risk-adjusted returns. First, Asia High Yield has an estimated correlation of 0.6 with the S&P 500 index, which allows capturing of an alternative source of market beta for equity-heavy portfolios, while its negative correlation with US government bonds can be a good diversifier for core fixed income portfolios. Second, as we expect global interest rate to be lower for longer, this fund can help enhance the yield level of a portfolio, just as we mentioned earlier. Lastly, return on a risk-adjusted basis, an important factor to investors. Asia high yield has historically outperformed Asia equities, global high yield, and EM external debt.
Stephen, thanks for joining us today and for all the insights you shared.